Welcome to CEO Zones, Meet the Speaker series, where we're focused on serving our CEOs and owner members with proven keynote speakers, knowledge, and thought leaders that are most interested to CEOs and business owners. My friend Adam Smith joins us today. Adam is the father of three children. He's quite proud of them when you get to talk to him one-on-one. He brings extensive global expertise in private finance, family office, and strategy. He's participated in several billion dollars of transactions over his years, and his experience is in advising and investing in over 50 venture and private equity backed companies. Beyond that, Adam is a supporter of the arts, which we could get into in maybe a personal video someday, foreign affairs, and he's a lifelong classic pianist. And I didn't write this down, but I believe he was like age 5 when you started playing concert classical piano. He's the founder of Wisdom Board. He's also the founder of Family Audiocast. And this is our second Meet the Speaker together. The first one went viral, I'll say. It was about deal making and family enterprises, and it has over 104,000 views. So, welcome, Adam. How are you today?
It's great to see you again, Bill. Thank you for being your guest again. We'll cover some different topics today, so I'm looking forward to that.
Excellent. So I know you private equity family office people, you like to jump right in and get right after it. So today I thought we'd talk about trust in the corporate culture from your point of view. And one of the simple things would be, why does trust matter, and why is it such an important platform to build any business from? Matter of fact, any relationship, but any business.
Yeah, well, it's quite a large topic and very relevant today's world, of course, in both the corporate and the political, diplomatic spheres. So I think today we'll just talk more about the business side, as we discussed earlier. That whether it's in a family business or in not a family business, trust is earned over time. You have a lot of experience in consulting some complex, sophisticated clients, so you know take months and years to build that trust. I think it's particularly important in the family enterprise world and family offices and family businesses, because they're so particular, so personal about who they involve in their organizations. So it can take a good amount of time to build that trust to come in externally. Just like in the corporate world, you would have a need to bring an independent director onto the board of directors or hire a CEO. Especially in a family business, there takes a lot of courage to hire someone to run the family business externally.
Certainly does. So, have you ever seen examples where trust really manifests in the leadership, the employees, the investors? Do you have any examples you care to share about that?
Yeah, I think maybe we can talk a bit about private equity and we can talk about the family office world. So they can be ultimately quite similar as a commercial entity to invest and buy and build an organization to make money. But the journey, I think, is quite different between the private equity or an entrepreneurial held company and a family business held company. I've just served on 10 board of directors and will serve on another 10 board of directors, I believe. And so I've seen the trust be built and lost and evolve over time. Um, let's say within the private equity space, you need to build a board that brings additional credibility and ideas and open-mindedness to the founders and to the CEO, and trust needs to be built both ways, right? So the owner and the CEO needs to give and delegate some power to the board of directors. That's very tricky to give that up, even if it comes with money, because the board of directors in most private equity held, almost all private equity held companies, unless there's minority interest, that board really controls the company, and the CEO then serves at the pleasure of the board. You've seen that many times. I'm sure there's been some tricky conversations of who you're reporting to, who your client is, Is it the company at the board, or is it the CEO, co-investor, owner, chairman of the board? And then there's also the trust between the relationship with the CEO that may not be the chairman, and then there's other personalities on the board. So I think it's quite tricky at times. I've seen it on 10 different boards of private equity. It can get quite complicated when you juggle the desires of the owners, a CEO, versus the fiduciary desires of the board of directors that's legally empowered to do the right thing for the company. That's even more complicated in a public context, which we probably won't go into today. On the family office side, I think putting a board in at all requires a lot of trust because it's not really essential. It's more of a professionalization and a real courageous step up to create a board of directors if there's no investors. Increasingly, family office held companies are having private equity investors of minority or control stakes, and there's a massive gap in creating that trust to involve not only the investor but also the board of directors. Prior to the board of directors, most family-held companies have no board, or they might have a family charter or some sort of a council, but not a board of directors where the trust is given to a external entity that is supposed to be really responsible for the welfare of the company. That can include firing the founder or CEO of the company.
One of my favorite family large companies comes to mind there, where the chairman does retain the total shares. So he's the chairman, but all the other board members, except his son, the CEO, are invited in. And that makes a whole other mixture there, I'll say, as they crossed over $20 billion and went through some of those professional changes. So it's probably relevant for CEOs and owners to just take a minute. Do you have any stories you could share from your career of where mistrust happened within the board or within the
Yeah,
leadership?
yeah. Storytelling is always popular. It's easier to do it without names, but I can tell a couple of stories, of course. So I was in a situation once with a large private equity arm of an investment bank, super institutional. They backed a transaction with me years ago for $100 million. Quite a complicated transaction, and the CEO was installed in a context of promoting the transaction. Really liked the transaction and put it all together with a lot of scrappiness over many months, and it turned out to be a pretty good-looking transaction. It was quite difficult, but what turned out over time is that particular CEO, this particularly relevant in promoting and packaging a private equity transaction. When you're not the founder, you're really you found a company, you like it, you want to buy it, you want to bring in investors. So he became the CEO, and of course the business was challenging, and it was levered, and it didn't have a lot of pliability, which is a whole other topic in terms of capital structure and how it affects the management's ability to perform. So he had that working against him at time, but he just wasn't really qualified to take it all the way. So there was some dynamics of trust, essentially, where the communication, KPIs, information reporting, the way that the board decks and management information was provided was really not as eloquent or transparent as needed. And then the board really, was not working with the founder or anybody really embedded in the business. It was more of a spontaneous transaction, really manufactured transaction with a lot of pieces. So in that case, there was trust needing to be built, and then over time it diluted and it kind of broke, and then he was removed with the chairman of that company, which had even more experience in the industry and he had to really step in and have a job that he was not really looking to do. That's one example. Another example is in a family office that I've sold before. There to control, there was some investors that came in to control, and there are trust issues there. I think we're not really prepared enough through the transaction. The transaction moved too quickly, or there wasn't enough time between the parties, between the money and the owners, to build that rapport. Because there was investment bankers that were managing the two sides, right? So there's not as much space. This is a whole nother topic of how private equity transactions get done. It's a very quick process. There's not a lot of access. So in that case, there wasn't enough trust that was built, and then the family office actually did a reverse merger recap essentially and pushed out the bought out the private equity owners that were controlling owners with some work in order to find a new mate in that company.
So as we kind of we kind of had three topics as we started around trust, legacy, and then we're going to talk a little bit about harmony. But at the end of trust, you mentioned I might have done some consulting in my life, and I would always sit down with the teams and say, trust is mathematical, and they'd look at me like I'm nuts because it's emotional. But I would say credibility times familiarity divided by risk. That's trust. That's how far I can trust you. That's how long I'll trust you, etc. But moving to legacy, a family founder led business, that family office legacy is always maybe one of the reasons they don't trust straight up front. Will you protect my brand? Will you treat my people as good as I have or better? So, as we think about legacy, why does legacy matter in all the different organizations you work with?
Yeah, thank you for bringing that up again. It is my favorite topic, legacy. I just finished a 2 hour live webinar with experts from the Middle East and Europe this morning, where we touched on legacy and next gen and succession planning in family held businesses. But it's also relevant to founder led businesses. So these dynamics of personality emotions, I think, are ubiquitous across a family held business and a founder held business, because there's an emotional attachment, there's the pride, there's the hesitation to disconnect. But there's a big carrot hanging out there, especially as we get older and we're thinking about our own wealth, legacy, and children, and sort of also the other topic, which well, is the what's going on in the industry to affect the decision making of changing the legacy of flipping the company, selling it. Let's move on. Let's get out of here. uh, the barriers to entry are going down. There's transformation, technology. I think there's going to be, after we get through this tricky couple of months in the economy and political landscape, I do think that the rate of change will be significant in buying and selling companies and M&A and the next gen and recapitalizations. So on the one hand, legacy can end if founder moves on and it's bought just as a commercial transaction. But on the other hand, the legacy can continue as the brand, and maybe there's some children involved. I think it kind of relates to that continuity of the private equity strategic buyer and what the founders and family held business built. And sometimes that dynamic is financially driven, and sometimes or it's passion driven. So it really depends.
I can't agree with you more as I keep thinking of examples of family businesses that I've worked with, significant family businesses. Um, so how do you balance tradition with innovation when you have those founders, family, where we've done it this way for 100 years, Grandpa did it this way. Now, how do you bring innovation as part of the package? How do you bring that great balance of probably family values, tradition to innovation?
Yes. I have some jazz in the background. I hope that you'll get a little bit of that in the recording. It's better than other choices of music in my hotel. But I think innovation is a tricky topic, and the related broader topic, I think, of entrepreneurialism. You've coached a lot of CEOs and how they become better executives, and so innovation is super important. I think it's complicated now because technology is so ubiquitous and essential, and AI is now another layer of technology that is. We'll come back to that briefly, but innovation is really essential, particularly in non-corporate organization. So I think on the corporate organization, private equity, corporate, public companies, there's a certain drive towards commerciality that doesn't have the hesitations of the family or founder styles or passion or hesitations to grow dramatically. There's more a founder held company or a family office held company. There can be less urgency to transform with innovation, with technology infusion, with changing quickly. There's more patience. There's longer term capital orientation, more fragile approach to changing the operations and the rate of growth. That's not necessarily a bad thing. I think people need to give some room and some respect for the for any company, especially the family held company and founder held company, to not uh, be forced or encouraged or judged to grow or change in a way that is what others perceive they should do. They should, I think they should give respect to the way that company wants to grow. It's really it's the owner's business. So that I think that's where the tug of war comes in. Essentially, is when the next gen, when industry pressures, when a board is looking to grow because it's the right thing to do, or they have investors or their opportunities. That drive, that drive, right? That enthusiasm to grow, to create wealth and scale, uh, and involve innovation, let's say, and technology, like that can be battling right there with the owner's sense of lifestyle and comfort and or fear and concern of the rate of that growth, and much less who do you actually hire to do that work, right? And if you hire in Ernst and Young or Alvarez or PwC or IBM or niche organizations to implement that innovation change, um, as you know from Main Point to other organizations, like there's an education process to say this. We think this is the right thing to do. It's going to cost $1 million, $10 million, and this is the likely the outcome. But we understand that you really don't know what that is going to be. Um, that's very hard. That's a very hard situation.
Sure. Do you have any lessons you might share from working with multi-generational businesses?
Yeah, multi-generational, let's say, is is I think a little bit hard, can be harder or easier. So I'm looking at a let's say a sustainable farming business which has um, you know one layer of the family, and then there's a second tier of the family and owners and outsiders. And so in that case there is the first generation of the owners can look longer term as a privately held company without regard to investors or uh, even a sale. So there are a lot of family held businesses, family office held companies that are very comfortable in their own skin, and they are looking for continuity and to grow their margin and cash flow, and that cash flow feeds other parts of their life and their family enterprise or their family office or their children, and so on, their hobbies and passions. So that's one group of the legacy, let's say more organic legacy. And then, but then when multi-generational wise, if there's a next gen that wants to grow that faster, but as you said, you can include some innovation with AI, with tech, with transformation, overhauling all the back office, the technology engines, the capabilities. That's a massive consulting or CTO initiative that can really rip up the guts of the company for at least 6 to 12 months with some risk. So I think the next gen is often in a tricky spot to make those changes, encourage those changes, um, because either they should be qualified to do it internally or they have to gain the trust of the owners to do it externally. And either way, it can be very tricky. So I do think it's an important topic, and maybe it also relates to education and where the business schools are today in today's world. We're seeing a lot of different opinions at business school. We're seeing different approaches to what advanced education means in terms of what people learn, both from the liberalist perspective and the realist perspective. So I think the next 10 years, there's going to be like some massive changes in advanced education of what the curriculum is, and also people leveraging ChatGPT, AI, the next generations of bots with education that is not necessarily the business school. I just saw there was a post, I think it was might have been Mark Cuban or somebody that's actually, or somebody like him that has a scholarship plan to you can apply for, and you can win or you can pay for a whole custom advanced education program that's not business school in this new private label advanced education effort that's more custom and holistic and virtual. So we tasted that in COVID in high schools, private schools, public schools, colleges, and business schools. And I think that that's a really big issue because that forced schools to learn to go digital, and then all of a sudden AI is also forcing things to go digital that's outside the textbook, and that will affect innovation and the rate of change.
Okay. So as we go to kind of the third segment of today's recording, leadership and cultural harmony. That those are they could be rather combustible in some organizations and rather smooth in others. But what do you see as the CEO's role for getting to that positive work culture? We'll start there.
Well, there's lots of leaders that have covered that for decades that well. I like reading, John Maxwell, and we can go back to even Jack Welch and other leaders in the industry. So positive work culture is maybe even more important than it ever has been, but it's also seems like more challenging at the same time. I've worked at several private equity firms and also investment banks, and worked within corporate board contexts where culture is key, and it's also changing. So look, I think some companies and some CEOs and cultures take years and decades to build. It's easier to break it than build it. So I admire. I think we can all admire and look at the case studies and look at the reference points of positive culture that are built over time, because it takes a lot of sociological, corporate education, engineering, not just CSR, not just ESG, not just DEI, but actual like years and years of building a culture. And then it can change quite quickly. That's exacerbated by social media and virality, and also exacerbated by this earlier generation has more freedom, and they think more independently, and they're less patient with environments that do not fit their own perspectives, and they're less hesitant to communicate within the more traditional caste system of communication, and let things ride. So that's quite combustible, and that's really difficult for larger companies, I think, to create a sustainable culture. We can see, for example, Goldman Sachs has certainly changed a lot, and Salomon has been a sort of a different type of CEO, a different type of culture. Partnership structure changed. He's kind of ephemeral and quirky, but also he's very authoritative, and he's there's more range of connectivity and the vibe with him. But uh, at the same time, he has navigated the company through some difficult social, cultural, economic times, and putting aside one's opinion of the way that the board and different interests work, like Goldman Sachs is doing pretty good, and so for in that example, do you just change it up because there might be somebody better for the culture? Or do you accept that there are shortcomings in such a complicated culture? Like, how do you know that the next person coming in is going to, on a net basis, is going to improve certain areas of culture, but then there could be other areas so these elite CEOs that really nail culture over time, like they can't change it in a couple of years. I think it could take 5 or 10 years to change that culture. So, and then the last thing is like, how do you define a positive culture? Historically, that's sort of like you building something to last. You're building a cohesive organization. You're building a brand. You're creating wealth. You have margin. You have an ESOP. You're protecting your people. You have training programs. People stay longer. They don't leave. Um, they don't sue the company. It's more consistent. It's more sticky. Those are more the traditional definitions of a positive work culture, the continuity of the culture, and people happy. So not sure where that's going necessarily, right? Because continuity of something that's steady is being uh, is being sort of transformed a bit, and then the definition of happiness is also being transformed a bit in today's generation.
Certainly. You started to go there, at least I thought, since I know you where your mind was headed, but I was wrong. Can you talk a little bit about empowerment and transparency inside the culture of harmony, leadership, that big bag of empowerment and transparency? What do you think about that? Any examples of that you care to share?
Um, well, I'm not an expert in transparency. Or the let's say the psychological side of companies, but I have been working very closely with a dozen or so boards, 15 total boards in nonprofit and profit, and hundreds of investors and tens of clients, and talking to hundreds of family offices and analyzing this, or listening and engaging in this related issue of emotional intelligence, and transparency is part of emotional intelligence and trust and so on within the family office environment. But I think transparency is only one part of the solution towards a better culture. Um, Transparency is vital to having courage and sharing information both ways, from the employees, from the next gen to the owners, and also information about the company to the 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 employees of the next gen, and giving access to that information. Of course, it requires courage and mechanisms first to be transparent, but then that's only one piece of the string of what happens after that information and trust is open. Then there's the assimilation of the information, and there's also the emotional ego side that receives that information. So if those mechanisms are not in place to absorb that information, it can be a hot mess. So I think transparency is important, but equally as important is those leadership and cultural and governance mechanisms to take that information that comes into that culture, into that leadership mechanism. How do you distill that and utilize it in a way that's healthy without judgment, I guess, um, and reward those people for being transparent, for the good of the majority, without a lot of friction and tension. Uh, so it's only one part of the puzzle, I think, to have that open dialogue. I think it's might be overestimated as a standalone tool to be transparent and give information for sharing. Then what? So I'd like recommend the family offices and their owners and their the controlling uh, um, individuals and characters in that position to certainly create that culture for transparency, right? But then that's some really valuable information and courage. And if that is not handled well, then it will not only discourage that transparency, but it might flip the other way, and be somewhat worse off than it was in the first place.
So as we kind of get to the near the end of our time today, I had one more kind of big question for you, and that was around any governance best practices that come to mind from people and families that you work with.
You can continue to ask the tough questions here. So let's see. So best practices in governance. I mean, there are books written on this. I have formed a company focused on governance and boards and best practices because there's so much that I've learned that is good and bad and can be enhanced through some of these things we talk about: transparency, trust, outsiders, insiders, best practices, information flow, reporting, getaways, uh, being vulnerable, bringing in outsiders, rotating the board, taking better notes, having proper roles, uh, you know, uh, fulfilling the duties of the shareholders, but while also thinking about the value of people and culture and the softer side of capitalism. So I think when you think of governance, like it is really tied to the drive of wealth creation and really capitalism itself. And this is a topic that's very interesting to me and very complex. And I have a whole philanthropic effort and passion towards that topic of a more refined capitalism that does require governance, but also balances the inherent uh, drive towards wealth creation for its own sake to create legacy and scale, and of course profits, which can be redistributed to the shareholders and the employees, but also is looking at the sustainability of the organization and its own employees and community and products and brand and serving society with what the company produces. So they're like, this is not a socialist concept. It's more about looking at that purpose of the board, purpose of governance, purpose of what is the company supposed to do. It's much more clear in a public company context because the fiduciary duty of a public company is much different the minute it's public with public shareholders, because the laws around public shareholders are codified and regulated, and and that does not exist in the private market. So let's say, for example, an analogy could be you want to go buy a bunch of real estate buildings in West Palm Beach, and you're Stephen Ross, and you think there's $1 billion opportunity to buy some amazing properties in collecting and governing those assets. There's still regulatory, zoning, and local and state and even federal laws in those activities. But let's say you're wealthy and you want to govern a whole collection of fine art, and you want to spend tens of millions of dollars, hundreds of millions of dollars in art, buying and selling art and navigating, assembling art, and you have a collection and you put your kids in trusts, and there's like none of that is governed at all. So I think um, the community and the not so much the academic community, but I think that the media community and like the experts in best practices, looking at corporate governance, looking at corporate theory, capitalism, the purpose of governance, I think there is not enough distinction, perhaps, between the public and private companies. It's hating to be merged together because public companies are revered in certain ways, but then the private companies are getting bigger, and the venture capital cycle is getting longer, and these unicorns are massive. They're similar size to public companies, um, but governance is very different for a public versus a private company. So that's one issue that I think is underserved in the public arena today with press and academic theory and conversations on the short bit news. Um, so that's a massive topic for people to think about, and I think for you to think about with your clients as they get bigger. Private companies is what is best for the company, its legacy, and its owners and its employees, without trying fancy bells and whistles that are not really suitable for that company. I think that's something to think about. Um, it, where that private company has the luxury of making those type of decisions for themselves. Um, Whether they do it well or not is another issue. So that's a topic I wanted to bring up, in this conversation. Another more practical element of great governance is to bring in, ambitiously external input, advice, at least one independent director, and constant evolution and learning at the board of directors as if it's its own uh, ecosystem of leadership. So I think that's why I went on boards, why I want to go on boards. That's why I think it's still an underappreciated mechanism, despite all the reports and white papers and recruiting and all the experts and Corn Fair and everything. Like it takes a very particular leader to go deeper beyond the practical governance, like Gary Burnison does at Corn Ferry. Even though Corn Ferry is uh, in addition to being a great firm, Gary Burnison is a remarkable person, leader, author, and I recommend, as I have mentioned with regard to John Maxwell and other leaders. I think his recent book was quite unique and is incorporating the do good and do well and running the business as a commercial entity, but also with your heart. So that's an example of someone in a book and like juggling these complicated factors has done a good job in today's society, at least for now.
Excellent. As we bring this episode of Meet the Speaker to a close, CEOs and owners watching and listening to this point, I trust that you found out that you're going to like Adam as much as I have over the last decade and a half or so, somewhere in there. But to contact Adam, his website is rsacapitalpartners.com. His LinkedIn profile is R. Adam Smith. His website is adam-smith.com. And if I got that wrong, Adam, just jump in. And then since you're watching this, you'll see our logo and you'll see in the transcript our ability to get in touch with Adam through CEO Zones in our contact partner database. And he's also a member and a contributing content partner inside our online community. So he's real easy to find, even if he is traveling the globe, which he does quite frequently. Maybe sometimes different parts of the week he's in a different place. So I know yesterday you were traveling when we kind of touched base, but thank you so much for being our guest again. And it had two more thoughts as we bring this to a close. Be really interesting to have you and Ralph Ward, two content partners, talk about board governance, legalities, the family side of things, the public side of things. That might be something that we could put together. And I'm sure our two teams would have thought of that and told us that, but it just crossed my mind that we should do that to even go deeper into governance for our public company and family office, what I'll call larger family office clients. So thank you so much for being our guest. Thank you for a little bit of jazz music there, and have a great day, sir.
Thank you, Bill. Nice to see you today. Good job today. Thank you so much.
Take care.